Welcome to Stock Trek. My name's Gaurav. I'm an analyst at Intelligent Investor. I'm joined today by fellow analyst Alex Hughes. Welcome, Alex.
G'day, Gaurav.
Alex, we were just talking about what the most important thing is. And we're not talking about religion or anything useless like family or anything like that. We're talking about what really matters, what matters and how a business makes money. And we both came up with two different answers. We're going to spend the next 2 weeks going through those answers. So we'll do yours second, if that's all right. And I thought we'd do, mine's probably the more contentious one, so we might do this one first. So the most important thing that determines profit over time, in my view, is industry structure. And for me, that means that it's the idea that your profit level is not determined by you as a producer of a good or service. It's actually determined by your competitors. And that's why industry structure matters so much. It determines the competitive landscape, and it ultimately determines how much of sales you get to keep as profit and how much of sales gets competed away. And I think that holds for fast-growing and slow-growing industries and for large and small industries. We probably don't agree too much on this, but I'm interested in your take on it. What do you reckon?
It's interesting. I mean, Australia is the classic example where many of our industries here are concentrated and there's just a handful of providers. But when you mentioned this concept to me, Gaurav, I immediately thought of airlines. And it's an industry in Australia where there is also just a handful of providers, but over the long term, the economics have been quite terrible. So how do you reconcile, quite a concentrated industry structure for airlines, but then, poor economics? Is that because the other factors override the industry structure and they overrule that positive factor, do you think?
It's a good example because if you take airlines, for example, the most profitable airline route in the world is actually the Sydney to Melbourne airline route, and that's profitable precisely because there's only basically one or two providers who are able to do it. And yes, the nature of the airline business is important in setting the boundaries of profit, but your level of profit is determined by the competition. So the reason that particular route is more profitable than, say, the Sydney to London route, which is massively competitive and no one makes any money doing that, is because of the amount of competition in either destination. So I think that actually proves the point. And I think that's a good example of where that the most important rule thesis actually holds.
Okay.
But you're right that Australia is a land of oligopolies. Do you know if Australia is particularly more profitable than other jurisdictions? Is that the case?
I guess it depends what industry you're talking about. I mean, banks have been topical recently, and probably the best metric there is return on assets. And I don't think they are the most profitable. I think the US banks, in terms of return on assets, are more profitable than the Australian banks. So despite all the claims that they're over-earning and they rip off their customers, it doesn't actually flow through into the numbers there. So not for banks. I don't know if you have any other examples of other industries.
Well, I think I make the point that I'm not saying it's the only important thing, but I think it is the most important thing. So over time, I don't think it's management that determines your profit. I don't think it's the quality of your product that determines profit. I think it is how the competition reacts to it and what the competitive landscape looks like.
We mentioned airlines. Another thing on that subject is the US airline industry. And it's been quite interesting that over sort of the last 10 years or so, the industry has consolidated. I think in the 90s, the top four providers contributed about 60% of the total market, and today it's much closer to 90%. And during that time, as the industry has changed, the profitability of that entire industry has improved, and the stock prices have gone up, many times over the last 5 years. So that's an example where the industry structure has changed, and you see that directly translate into better economics. So I guess that supports your argument there, Gaurav.
And that sounds like a wonderful place to stop. Look, I might just quickly highlight that that industry structure, when I'm looking at a stock afresh, the first thing I do is probably look at the industry structure and see how the distribution of profits across that value chain works. Who in this industry is the one that actually rips up most of the value. So if you're looking at, for example, a battery maker, it's not the guy who makes the lithium who gets the money. It's not the commodity producer who generally makes the cream in that industry. So it's those sort of questions I think that can help you learn about what the ultimate level of profitability will be over time, because things like products and management are ultimately, I think, not as important as who you're competing with. Alex, you've got a different idea. Just quickly tell us what your idea is, and we'll get to that next week.
Okay, my idea is brand value, and the reason I've picked brand value is that when you look at studies of enduring profitability, it's essentially the companies that have brand value, that brand value has allowed them to earn and over long periods of time. So I think that longevity is really important there, and that's why I think it's probably one of the most important factors to earning profits over long term.
Okay, well, you've heard the case for industry structure as the main driver of profits. Well, next week we're going to talk about the case for brand value.